Hello, everyone. Thanks for joining us today for our Back to Basics webinar. I'm Eryn Campbell, the Regulatory Research Services Manager at the NAIC Center for Insurance Policy and Research. And on behalf of CIPR and the Institute's Griffith Foundation, welcome to the 12th installment of our Back to Basics webinar series. The goal of our series is to take a look at the fundamentals of an issue in the insurance space to better inform public policy conversations. Previous webinars in this series have covered topics like captives, fraud, reinsurance, surplus lines, and guarantee funds. Our session today will cover the historical foundations and structure of reciprocals. We'll explore the current landscape and examine current issues in the regulatory space with our panelists. Our expert speakers for today are Dr. David Russell of Cal State Northridge, Brian Bolash from Erie Insurance, and Bruce Jenson from the NAIC. Our Q&A segment will be moderated by Frank Tomasello of the Institute's Griffith Foundation. I'm going to place a link in the chat to our materials for today, which include slides, bios for all of our speakers, DRC information, and a link to all the previous recordings of our Back to Basics webinars. This webinar is being recorded, and the recording will be available in the next few days at this exact same link, and as also on the CIPR and Griffith websites. We'll be using the Q&A function for questions, and we'll try to get through as many as possible at the end of our program. So please feel free to drop your questions in that Q&A area as you have them. At the end of the session today, you'll be prompted to fill out a very brief survey, and we would appreciate your feedback on this webinar as we plan for future events. And now I'll hand it over to Dr. David Russell to kick things off.
Thanks, Eryn. It's great to be here. It's morning here in Los Angeles. Good afternoon or good morning wherever you are. I will share my screen, get started. As a reminder, my comments will be non-advocative and educational only. I'm not advocating for any particular regulatory position. So let's start with the fundamentals of reciprocals. Technically, it's called a reciprocal exchange, and a reciprocal exchange is an unincorporated pool of insureds. So it's very similar to a mutual in that the insureds are covering one another's losses. The members or subscribers to a reciprocal are owners of the reciprocal. It's managed externally, and this is a difference from mutual companies. It's managed externally by an entity called an attorney in fact. It sounds like a person when in fact the attorney in fact is probably a company or corporation. This is governed by an agreement between the attorney in fact and the pool. And it's further governed by a subscriber's agreement. So when an insured enters the arrangement, they fill out a subscriber agreement and power of attorney that governs the relationship they have with the manager, that is the attorney in fact. Alongside this agreement, the subscribers may be asked to contribute surplus, either as part of their premiums or in some other fashion that we may discuss later. So a little background on reciprocals themselves. This started in 1881 with 6 New York merchants who at the time were looking for a better deal. They had adopted fire control sprinkler systems, and as a new technology, they weren't receiving rate credit for this this technology that would enhance their risk profile. And so what they did is they formed this arrangement, but hired an outside manager. This arrangement ultimately became known as individual underwriters, and it grew as word spread that they were getting superior terms. Originally, there were no premiums paid. Rather, there was a bill sent to members, and ultimately this became unworkable because of delays in paying the bill, and this was replaced with a deposit. Now, if losses exceeded the cash on hand, there could be a capital call of up to 10 times the deposit. But in most years, according to researchers, the arrangement ran a surplus, and this money was set aside for the benefit of the future, but it also was placed in individual accounts for those subscribers. So that also will come back later in our discussion. So a couple of researchers that when these slides are shared with the group, if you want to read more about the historical aspects, you can see these two sources. So I've included some pictures because the real heyday of getting started was before the Depression. So you'll see an image of 4 prominent reciprocals that I will outline on the next page. You see some Army officers, you see an application for Erie, you see a discussion for farmers insurance, and then you see a roadside patrol service for the Auto Club of Southern California. So Insurance Exchange is out here in LA. It started in 1912, and it was formed by the Auto Club to offer insurance to its automobile club members. USAA was an organization of 25 Army officers in San Antonio, where it remains headquartered today, who agreed to insure each other's vehicles. And over time, the total addressable market of officers was fairly small, so they broadened that now to serve military and their families. Through my father, I'm a member of USAA, and my son has automobile insurance with them. Erie was formed in 1925, and it was, according to their website, was formed to provide better service. So its founders departed another organization and decided we're going to do a better job, and they formed a reciprocal. And also here in Los Angeles, farmers insurance was provided farmers with a way to get better rates when compared to urban customers. They felt like farmers were better risks and deserved better rates. So that's why Farmers was formed. So today, according to insurance broker Howden, there are 71 reciprocals out there writing about 6% of US premiums. So how are reciprocal exchanges formed, and where do they get their capital? After all, insurance requires a commitment of capital to back the promises. So they're capitalized in most cases by something called surplus notes. And if you're not familiar with surplus notes, they are debt instruments that may be treated as debt by generally accepted accounting principles, but because they're junior to everything else, including the payment of claims, they're treated as regulatory capital or surplus. Some reciprocal exchanges actually are also capitalized by a commitment to provide additional surplus notes if that becomes necessary and the capital is somehow depleted. And as I mentioned earlier, policyholders may also contribute surplus alongside their premiums. Many reciprocal arrangements require, let's call it another 10% of your premiums in order to capitalize the reciprocal. And of course, if the reciprocal runs a surplus, that also enhances the capital profile of the reciprocal. In some cases, this is actually assigned to each individual subscriber. For example, USAA, if you are a subscriber, you build up a subscriber savings account. Now, I'm going to show you later a graphic that shows that a sponsor oftentimes invests in surplus notes to align its interests with the subscriber. So it's putting capital at risk, although it's in a debt instrument. So that reduces moral hazard on the part of the sponsor. So who owns these attorneys in fact? Now remember, an attorney in fact sounds like a person or a group, a law firm, but in fact it's a management company. In the case of USAA, it's actually owned by its members. In the case of Erie, you can actually buy shares on NASDAQ in the attorney in fact. And Farmers, which has several exchanges, is that management company called FGI, or Farmers Group Inc., is owned by Zurich. So the economics of reciprocal are quite familiar to those of you who may know what an MGA, or managing general agent, is. So we're getting to the sort of timely issue of reciprocals. Reciprocals are being formed in much higher numbers now, even though they're over 100 years old in terms of the concept. And one of the reasons is the attorney in fact that manages these generates very stable fee income. The underwriting risk remains with the subscriber base in the risk sharing arrangement in the pool, but the attorney in fact gets a stable fee. And this is governed by the agreement and to some degree regulators. And one of the motivations behind forming an attorney in fact is that because the fee income is very stable and doesn't have underwriting risk, it receives a much higher multiple in the marketplace on earnings than an outright carrier. So some sponsors, if you're going to start a new insurance entity, you may prefer to do a reciprocal transaction and own the attorney in fact, as opposed to capitalizing a new carrier. And this also gives you an incentive to take an existing carrier and maybe convert it to a reciprocal arrangement and do a book roll. So reciprocals that get started oftentimes use a lot of quota share and excess of loss reinsurance. But later, as they develop a larger capital base, may decide to buy less reinsurance. Now, I've talked with industry participants, and they believe that the pool of subscribers can't be adversely selected. Rather, it should be positively selected. Otherwise, reinsurers won't be interested in the transaction. And because young reciprocals depend on reinsurance, they, of course, want to make sure that reinsurance is available. So I'm going to give you 2 slides on the formation stage and capitalization stage of reciprocals, and then later an operating stage. So a sponsor that sort of creates this arrangement creates an attorney in fact, and they get ownership in that attorney in fact. Now this is a sort of a busy aspect to the flow chart here, but the sponsor puts in money into the reciprocal exchange so that the reciprocal has capital to bear risk. They also may recruit external investors in these surplus notes. And both the sponsor and these external investors likely receive some sort of ownership in the attorney in fact. The subscribers who pay premiums to the reciprocal don't own the attorney in fact, but they do own the reciprocal, and they may contribute money through what are called member surplus contributions, oftentimes as a percentage of premiums or through their ownership. When we're up and running, a reciprocal has whatever underwriting results it has, and it shares those results with the subscribers. The attorney, in fact, provides services such as claims, distribution, administration, and in return receives fees. Of course, we have reinsurance transactions off to the side, and the reciprocal uses premium dollars to pay for that. The sponsor, over time, will hopefully get an attorney in fact that's making money, and they may receive dividends from that, but they certainly have the equity value in the attorney in fact, which is ultimately their motivation behind this transaction. As a reminder, there are surplus notes that are backing the insurance policies, and in good years, they will pay interest. In a bad year, the insurance commissioner can actually block the payment of interest on the surplus notes. That is, they must approve the payment in all years, but they have the ability, if the reciprocal is short on capital, to preserve capital inside the reciprocal and not pay interest on those notes. And as a reminder, the subscribers may also receive the savings account value that has accumulated in each individual accounts. Not all reciprocals offer that. Other reciprocals say that as the reciprocal does well over time, they can offer lower rates. So my last slide is a quick case study on a recently formed reciprocal, and that's Ovation Home Insurance Exchange down in Florida. It's managed by Ovation Risk Managers, and Ovation was sponsored by another manager called Windward. Windward is responsible for the management of two other insurance entities. So we all know the issues in Florida surrounding wind, and it's been a good year, at least so far, but it isn't always that way. And Citizens has been on the hook for a large market share, and Florida regulators are looking to depopulate that. So they're very motivated to find homes outside of Citizens for wind risk. So Ovation is managed by Ovation Risk Managers, and they receive a 32% fee through the attorney-in-fact agreement. This is overseen by the subscriber advisory committee, but my reading of the subscriber agreement is that the subscribers can't vote to change the fee. In some arrangements, they can vote to change attorneys in fact, but that does not appear to be the case in the Ovation. So what does the attorney in fact agreement provide for that 32%? As I mentioned earlier, underwriting, claims, marketing, financial, legal, IT, and growing the pool. So hopefully Ovation is successful and surplus accumulates, and that may reduce future premiums. Ovation does not allocate surplus to individual subscribers. So I'm going to turn this over to Frank, noting that because Ovation is very small, it's rated by Demotech, and it also, as I mentioned before, that it uses a large amount of reinsurance. So these young reciprocals are getting up to speed, and we're seeing a lot more applications to regulators.
Professor Russell, thank you for providing an outstanding treatment of foundational information on reciprocal exchanges. Before we turn things over to our next presenter, let me take a moment to remind our audience that we will devote the final 10 minutes or so of our time together today to Q&A, as Eryn Campbell mentioned at our opening. You may submit questions for our presenters through the WebEx Q&A feature. We will review incoming questions, and during that Q&A segment, we will address as many questions as time permits. With that, let's turn now to Mr. Brian Bolash, Executive Vice President, Secretary, and General Counsel at Erie Indemnity Company. He will help us to appreciate how reciprocal exchanges are being used today. Brian joins us in audio-only form today. Brian, thank you for being with us. The floor is yours.
Thank you, Frank. Hope everyone can hear me all right. And I do apologize for not being on video. Some technical difficulties have prevented that. However, I'm happy to be here, at least in audio. What I'd like to do is try and I'm going to talk a little bit about some of the things that David Russell spoke about. I'm not going to give it to you necessarily in the same way, maybe a little bit of a different vantage point on some of those things, and kind of talk to you about life at a reciprocal. You know, we're here, we're the boots on the ground in an operating reciprocal insurance entity here, and give you a little bit of a look at what that's like. So Let me start by first kind of going back to the formation of the insurance companies and talk about how reciprocal is actually a little different than the other types of insurance entities that are out there. With a stock insurance company, if you can imagine any corporation, you've got investors who put up money to start a business. That business manufactures widgets, they sell those products, they pay their expenses, and hopefully at the end of the day, there's money left over, there's a profit, and that ultimately gets dividended out to the shareholders who put the money into the corporation to run that business. Stock, property, and casualty insurance company is really no different than that. It's just that instead of manufacturing widgets, their product is insurance, and they're hopefully going to achieve an underwriting profit, meaning they're going to take in more in premiums than they're paying out in claims, and they're going to have some investment income. And at the end of the year, hopefully they're on the right side of the balance sheet, or the income statement, I should say, and they ultimately will dividend those profits out to their shareholders. With a mutual type of company, we're talking like Liberty Mutual, State Farm, Nationwide, it's very much the same process, except that your shareholders, generally speaking, are your policyholders. So to the extent that the insurance enterprise is able to achieve a profit, that inures back to the benefit of the policyholders, either in the form of policyholder dividends or lower rates going forward. With a reciprocal, like USAA Farmers or Erie, and many of the smaller ones that are out there that address issues in the medical malpractice field and auto clubs, things like that. With the reciprocal, there really is no actual company. It is a coming together, if you can imagine this, of different individuals and companies who are agreeing to exchange policies of insurance with each other. We typically at our company do not refer to the exchange as a thing, but rather a place where, again, this exchanging of insurance promises takes place. Every subscriber, which is what we call our policyholders because you need to sign the subscribers agreement, we'll talk about that in a minute. Every subscriber or policyholder in this arrangement is both an insured and an insurer. So again, you're getting insurance for your car or for your home, but you're also promising to supply the money that's necessary to pay the claims of your fellow subscribers in that reciprocal. So let's talk about who forms a reciprocal. I mean, if you go back to its origins, it was smaller groups of similarly situated individuals. As David Russell mentioned, the dry goods merchants who sat around a table way back when in the 1800s and were kvetching about the price of insurance, even though that they were a better underwriting risk, and they decided essentially to insure each other. That was really the genesis of the reciprocal industry at that point. So it's almost always somebody looking for less expensive insurance or a way just to get insurance that they otherwise could not obtain. That was the traditional problem statement. Today, one could suggest that the marketplace irregularities like we've seen in Florida over the past few years would lead to more innovative solutions being sought in the insurance industry, such as a reciprocal form. If you look at the enabling legislation, as I call it, which is really the statute that recognizes the existence of reciprocals, it's very short and very simple. It says that individuals and partnerships and corporations are hereby designated subscribers, and they're authorized to exchange reciprocal or inter-insurance contracts with each other or with individuals, partnerships, and corporations of other states and countries, providing indemnity among themselves from any loss which may be insured against under any provision of the insurance laws except life insurance. So if you think about life insurance, that requires a different type of a capital model. Unlike reciprocal exchanges, which are ordinarily established for property, casualty, and liability type risks, life insurance needs to manage a long-term, predictable risk pool over decades that requires significant capital to guarantee those future payouts. So not ideally suited to a reciprocal model. As an aside, Erie Indemnity Company is our attorney in fact. and we're going to talk about the attorney-in-fact role here in a second. And it is, as David mentioned, it is a public company. It's also a family-controlled public company. We never wanted to be a public company. We kind of backed into that back in the 1990s when we had too many shareholders of Erie Indemnity Company. So we find ourselves being this attorney-in-fact. We're, I believe, the only publicly traded attorney-in-fact for a reciprocal in the United States. And then we also have that unique twist of having the family control of that public company. So it creates a rather unique corporate governance structure, balancing the regulation of the indemnity company and the SEC rules, along with all of the insurance regulation. So if we then turn to about reciprocals functioning in practice today, both Erie and Farmers utilize the independent agency model to sell their insurance. Since the agent owns that book of business, we at Erie, and I'm not going to speak for other insurance companies, we help our agents with some marketing costs, but we do not engage in the advertising campaigns that you'll see with Geico, Progressive, Liberty Mutual, and some of the others. So we operate through the independent agency system. They bring us the business, the renewals, the book belongs to the agents, the independent agents themselves. If an agent is going to place a risk, a policyholder with Erie, that potential policyholder then signs that subscriber's agreement. We have different companies in our group. Many insurance companies out there are formed as a group where they have different insurance entities for different reasons. The exchange is where we write our preferred risks. And if you think back to the days of those dry merchants who were sitting around the table, they weren't hoping for adverse selection. These were folks who were saying, hey, we've done what we need to do to make ourselves great underwriting risks. We think we're still being overcharged by the insurance industry. So let's agree that we're going to kind of insure each other in that format that David Russell explained a little bit earlier. And as additional folks would come along, I'm sure those 6 dry merchants were looking at them saying, well, here comes Joe, and he's had 4 factories burned down in the past 3 years. Maybe we don't want to let him into our group. So again, there is that factor that you don't want the exchange to be adversely selected by these individuals and these policyholders who should maybe otherwise be paying higher premiums or be put into a more standard or substandard type of arrangement. In theory, every time we get a new subscriber to our exchange, to Erie Insurance Exchange, and again, I'm talking about in theory, they exchange policies of insurance with all of the other subscribers. At Erie Insurance, we have millions of different subscribers. It is difficult for everyone, obviously, to get together every day and swap policies with new members of the exchange, or to adjust the claims that were submitted the day before, or to prepare the regulatory filings. So therefore, as you sign that subscriber's agreement, you're appointing an attorney-in-fact. And that, what I just mentioned to you, the swapping of the policies, adjusting claims, regulatory filings, that's the job of the attorney-in-fact. That's what my employer, Erie Indemnity Company, as attorney-in-fact for the Erie Insurance Exchange does. The attorney-in-fact handles the theoretical exchanges of the policy, takes care of the claims handling, otherwise runs all the insurance aspects of the operation. The attorney-in-fact is not generally an insurer in and of itself, but rather a management company. In the theoretical concept of the exchange, which is recognized as a legal enterprise, in other words, it can own assets, it can own bank accounts, it can be involved in litigation. There are no employees at the exchange. There is no management in the exchange. There's no board of directors. There might be a subscribers advisory board, which is sometimes mandated in certain states, but that advisory board does not have the authority to run the day-to-day business or the insurance operations of the reciprocal. In exchange for performing all of these services, the attorney-in-fact charges a management fee to the exchange, which is typically calculated as a percentage of each premium dollar charged by the reciprocal to its policyholders. It is important to note that, as you compare exchanges one to another, the management fee structure is not always the same. I think David Russell mentioned earlier the Florida reciprocal that was charging, I think it was 31% of premiums as a management fee. Erie Indemnity Company charges 25% management fee. So it's hard to look at just that and say, well, which one's better, which one's the better deal, which one's operating more efficiently, because what we don't necessarily know is what expenses that attorney, in fact, is required to pay from the management fee. At Erie Insurance, our management fee is 25%, but as provided in our subscribers agreement, which the policyholder must sign before becoming a part of the exchange, that subscribers agreement delineates the types of expenses that the attorney, in fact, must pay out of its 25% management fee. So again, as you look at reciprocals all across the country, they're very different. They charge very different levels of management fee. But what you have to do is look beyond that and see, based on some of the organizational documents like the subscribers agreement, what expenses are actually being paid by the attorney, in fact, and what expenses actually remain with the exchange and are paid out of the remaining monies, premium dollars that are not paid to the attorney, in fact, as a management fee. If we turn to the day-to-day operations of a reciprocal exchange, exchanges operate and are regulated largely the same as other forms of insurers. We sell policies, we're paying claims, we're investing premium dollars, we're subject to the same statutory investment limitations, marketing requirements, market conduct and financial exams, rate filings, et cetera, that any other insurance company has to deal with, or any other form of insurance company, be it a mutual or a stock property and casualty company. David also addressed in his comments the additions to surplus and how that can be accomplished through underwriting profits and potentially contributions from subscribers. At Erie, we've been established for long enough. We're celebrating our 100th year in business here in 2025. We've been around long enough to build a significant surplus. We have surplus around $10 billion at this point, such that our policies are no longer assessable. In our earlier days, significant losses from claims could have resulted in additional assessments to our subscribers. Now our surplus goes up and down based on underwriting profitability and investment results, and we have removed the possibility of assessing our policyholders in the event of extreme losses. That is no longer part of our policy with our subscribers. If we think maybe about the advantages and operational challenges of reciprocals, a lot of individuals, including customers and even some agents, don't understand the structure of a reciprocal or what it is. I can't tell you how many times I get calls from agents or from policyholders or their attorney calling me asking about the subscribers agreement. In particular, why is their client giving Erie Indemnity Company a power of attorney? And I have to explain to them that it's a limited power of attorney. You're authorizing the attorney, in fact, to handle these insurance-related matters on the policyholder's behalf. This doesn't allow Erie Indemnity Company to go into their bank account and handle their business transactions. It's strictly a limited power of attorney limited to the actual business of insurance. Today, we're seeing a significant increase in the number of new reciprocals being formed. A recent industry article reported that no less than 28 new reciprocals have been formed in the United States since 2020. 10 of those were in Florida and Texas, which have been home to a lot of hurricane and convective storm activity. It suggests that these reciprocals offer another option to their subscribers when some of the admitted market companies were taking a step backward, particularly with respect to homeowners insurance in those areas where you've got those extreme weather events. Some challenges that we're seeing in the reciprocal world today include management fee litigation. We have been under for probably about a decade a number of different pieces of litigation involving our management fees. And I know that there's also been some activity on the NAIC front to look at potential regulation of management fees and potential other areas where regulation of insurers may be warranted or put forward. But with that, let me save some time for Bruce so that I can hand it over to him. But let me first pass it back to David. I'm sorry, pass it back to Frank.
Brian, thank you very much. We appreciate your comments, and we look forward to bringing you back into the conversation for the Q&A segment, which will be the final segment of our time together. But for now, it's a pleasure to welcome Bruce Jenson, Director of Solvency Monitoring and Accreditation at the NAIC, to our microphones. Bruce, always a pleasure to collaborate with you and your colleagues. We have a lot of ground to cover. We have limited time to do so. So where would you like to begin?
Yeah, so I don't want to rehash some of the same ground that Dr. Russell and Bob covered, but I did want to just talk a little bit about kind of the regulatory perspective on this. And unlike the other two panelists, I'm not a reciprocal exchange specialist or expert, but I did some research into the regulation of reciprocal exchanges, and if there's any differences there between a reciprocal exchange and other types of insurers. And largely the regulatory requirements apply the same to reciprocal exchanges as they would to mutual insurers or stock insurers. So most all of the regulatory accounting, reporting rules, examination, analysis standards are implemented the same way for a reciprocal exchange as they would for any other risk-bearing entity. However, there are some unique aspects. There is an NAIC model law known as the Model Indemnity Contracts Act. It's model number 356, which is really the model that allows or authorizes the formation of reciprocal exchanges. So it authorizes individuals, partnerships, and corporations to exchange reciprocal or inter-insurance contracts with one another to indemnify themselves from loss. So it's really that model law that allows the formation of reciprocal exchanges. That model has not been revised since 1918. So kind of World War I era, I think that's where Dr. Russell showed a lot of the first gen reciprocals were formed around that time. The model has been adopted according to NAIC records in 46 different states. The model or similar legislation has been adopted in 46 different states and territories. I should mention, though, a lot of those, we call it having a related activity, so not the exact NAIC model was adopted. So there's a little more variation from state to state in the laws related to reciprocal exchanges. Also important to note that model law is not part of the NAIC accreditation program. That's why it's only been adopted by 46 states. So there's a little bit less uniformity and consistency in that area. In the early 1990s, it's my understanding that there was some additional discussion about regulation of reciprocals and their attorney in facts. And in fact, there was another NAIC model that was developed to outline certain standards that would govern that relationship between a reciprocal and the attorney in fact. It was known as the Reciprocal Attorney in Fact Model Act, was model number 355 at the NAIC. However, after that model was developed in the early 90s, there were some issues identified with it, and only a couple of states ever adopted it. And because of that, it was subsequently archived as an NAIC model. It's no longer published and maintained on our website. And so that there's not a lot of consistency and uniformity, particularly in that space when it comes to governing that relationship between the reciprocal and the attorney in fact. Different states have some different rules in that regard. Obviously, with the recent increase in the number of reciprocal exchange formations that I think both of the presenters have talked about, there's been some more light shined on kind of these relationships between the reciprocal exchange and the attorney in fact, the fee issues, the governance, how do some of the rules apply. So that has sparked more regulatory interest in this space. In fact, there's currently some discussion underneath the Financial Condition E Committee of the NAIC to form a new working group that will investigate and look into whether a new model law or revisions to existing model laws are necessary to provide some more clarity about expectations for that relationship between the reciprocal exchange and the attorney in fact. So, for example, are the service agreements in place between the AIF and the reciprocal subject to regulatory review and approval, and subject to the fairness and reasonableness standards that are associated with affiliated transactions under the Holding Company Act. Obviously, there's some argument to be made is the relationship between the reciprocal and the AIF, are they affiliates? Is that a third party relationship? It's a little bit different relationship, and there's some gray area there. That's why there's discussions being held in that regard. But obviously, it's clear that the AIF is granted a lot of authority to underwrite and bind policies for the exchange, to administer insurance operations. Although there's some level of oversight typically by a subscriber board that can vary from reciprocal to reciprocal. And so there's not a lot of uniformity and consistency in this space in determining what should that governance look like, how should those agreements be reviewed, what sort of standards should apply to that review from a regulatory perspective. So the E-Committee is looking into that, has proposed the formation of a working group to study those issues and try to develop some more uniformity, consistency, and expectations in that space. We expect that proposal to be discussed at the NAIC Executive Committee at the upcoming fall national meeting this December in Hollywood, Florida. So it is really a timely topic that we're talking about this today. There are a number of questions and issues that emerge, driven largely by a lot of the new formations. So with that, I'm going to turn it back over to Frank, and I think we're going to cover some questions.
Thank you, Bruce. Indeed, we will. We'll devote the remaining time to Q&A, and we invite all of our panelists back to weigh in here on these questions. We have a number from our audience. We'll delve into them. To begin, let me ask panelists, do reciprocals face any challenges competing with larger, very well capitalized stock or perhaps mutual companies? Are there challenges, for example, with reciprocals accessing reinsurance markets on favorable terms? Welcome your thoughts there.
I'd like to weigh in briefly on this because I have had conversations with significant reciprocal enterprises that lament, in some cases, the headwind that the management fee creates for the rates that need to be charged. So to be competitive, you need to keep rates down, but in order to run a favorable loss ratio and pay the management fee, it can be a challenge to navigate between those two rocky shores. It's especially difficult to compete with large carriers, say State Farm, that have such enormous surplus bases that they enjoy investment income from that base and are able to effectively subsidize their rates. So the management fee that emanates from the reciprocal structure can cause competitiveness issues.
Professor Russell,
Brian,
thank you. Brian, you want to weigh in there? Apologies, didn't mean to step over you there.
Not a problem. I would just add on top of those comments that, number one, we haven't had had issues with reinsurance, so that's not been an issue for us. But true that the stock, property, and casualty companies, I mean, they're interested in keeping shareholders happy. They're gonna pare things down as much as they can in terms of capital and distribute what they can out to shareholders. So it's a different model, and I think you've got to recognize that up front as you're looking and comparing. Yes, we're all competing in the same industry. We're competing for the same policyholders, but there's different models, and you've got to bear that in mind as you view performance.
Thank you, Brian. Bruce, anything to add there? Any color on your side?
I'll just add, I don't know that I can speak to the difference between a reciprocal and a another traditional insurer in terms of accessing reinsurance markets and the cost. But I think it is important to understand that a lot of these new formations are occurring in areas where it may be difficult to obtain coverage, coastal policies. So areas where reinsurance is already difficult to get access to and expensive. So I think that definitely impacts a certain number of reciprocals, whether it impacts them differently than a traditional insurer, mutual or stock company. Can't really speak to that, but I think that is something to keep in mind, that a lot of companies are dealing with reinsurance issues and cost of reinsurance for catastrophe coverage.
Thank you. Want to switch gears and pose a couple of questions that were submitted that sort of harken back to some of the foundational materials that Professor Russell spoke to earlier. Professor Russell, you may care to lead off with responses to these questions. Can you speak to the difference between a reciprocal exchange and a self-insurance group that's managed by a TPA?
That's a good question. I think it depends on the contractual arrangements. Not all of the reciprocals work the same way, and a risk retention group or a self-insured TPA arrangement may resemble the economics of a reciprocal. So there are parallels, but in the details of the arrangement, I think there can be differences for governance, for fees, for allocation of duties.
Thank you, Professor. Anyone else care to offer anything else in response?
Nothing here.
Okay. In that case, Professor Russell, if I may, could we call upon you as well to take a moment and speak to this question submitted? Do the terms subscriber and policyholder have the same meaning within the context of reciprocal exchanges?
It's my understanding that they do. They may have different definitions, but they are one and the same in terms of the identity. And so I had noticed something else while we're on this topic in the chat about subscribers who may depart the arrangement. And in some of the agreements, if you've accumulated sufficient funds or have a long enough tenure with the reciprocal, in fact, when you leave, you do take your subscriber savings account with you. So in addition, if you left mid-policy period, you not only get your unearned premium, albeit at the short rate, but you'd also get your SSA back. So there is some ownership, if you will, in the reciprocal, but not all reciprocals offer that vesting of ownership.
Thank you, Professor. Brian, Bruce, anything to add?
This is Brian. I would just add that I agree that the terms subscriber and policyholder are used interchangeably. I think we tend to look at policyholder more when we're speaking about kind of the whole regulated business of insurance. You've got insurers, you've got policyholders, you've got claimants, and these folks are the policyholders. And I think, as Professor Russell just indicated, that within the context, within the structure of a reciprocal, those same individuals, those same policyholders have a different title, and that is subscriber, and that discerns certain rights and responsibilities that they have within this contractual framework known as a reciprocal exchange, including the subscriber savings accounts that Dr. Russell just talked about. So I think within the context of the exchange and that structure, and if it's something that we're talking about related to the exchange, we tend to use the word subscriber. If it's a bigger picture of the insurance industry, they're policyholders, and again, they're pretty much interchangeable.
Thank you, Brian. Bruce, anything to add there?
I'll just add that I agree with Professor Russell. I believe that there are some different terms in place across different reciprocals in terms of how the subscriber accounts are handled and when they vest, and what is returned to the subscriber based upon, when they choose to leave the arrangement. And so I think that's governed a little bit differently and per contract that different reciprocals set up, is my understanding. It does complicate to a certain extent some of the accounting and reporting around that. When does it vest? When is it due back to the subscriber if they were to leave the reciprocal? Is it represented as equity? Is it a liability? There have been some questions raised about that in the past. That may be something that gets revisited again in the future from a statutory accounting perspective. But there is some gray area, and it's not necessarily uniform and consistent across all reciprocals, is my understanding.
Thank you, Bruce. Panelists, we'd appreciate a moment or two of your thoughts speaking to insolvencies through the lens of reciprocal exchanges, and perhaps sort of contrasting that with insolvencies involving other structural scenarios.
Frank, I'll confess ignorance on the history of reciprocal insolvencies, and Bruce is the solvency expert, so the burden's going to fall. It's going to fall on him. But there's no doubt that especially since so many of these arrangements are popping up in catastrophe-challenged areas, solvency and resiliency is very important. And as my case study indicated, some of these entities that need a rating are getting it from Demotech, and that's suggestive of scale and a different set of standards.
Well, I'll just add that unfortunately I didn't do the research to prep for this panel about the history of reciprocal exchange insolvencies. My guess would be that we have had some experience in that regard, although I can't recall one in the last few years. I will say, though, I did see a question in the chat about, in the event of an insolvency, would the attorney in fact have any obligation or liability for claim payments and whatnot? And my understanding is no. I'm sure Brian can speak to that as well, but the attorney in fact, again, is a management service company, and so they have no obligations to support the business that's exchanged through the reciprocal.
Thank you, Bruce.
Right.
Brian?
I would also add that a lot of the reciprocals that exist today are very small compared to the major players that are out there in the market today. So a lot of the reciprocals, you wouldn't even know or recognize the names. They're more local. They're more organized towards a particular business or some, again, like I refer to it as like an affinity group that's coming together. So there may have been more insolvencies out there, but they just are things that, unless you are the regulator on top of that particular entity, you may never have heard about them. So I'm sure they do exist, and particularly again in some of these catastrophe challenged areas, to the extent that they're forming now, you can bet there probably will be insolvencies in the future.
Panelists, appreciate your thoughts there. Our time is rapidly evaporating. Let me ask you all to gaze into the future. Over the next 5 years or so, where do you see the greatest opportunities for reciprocal exchange growth? Are there underserved markets that reciprocals might be in a unique position to serve in the years ahead? What are your thoughts there?
I'll jump in here. I believe that we're in a business-friendly environment, and we also have certain areas that are motivated to depopulate FAIR plans or public risk vehicles like Citizens in Florida. And with that, you have opportunity. And with private equity looking to put money to work and diversify, you're seeing more applications, and what Committee E comes up with on putting guardrails around returns or fees, I think will dial up or down the pace of entrepreneurship in this area. I think it can be a really interesting and creative way to solve, Brian referred to local problems. So a group of like-minded people, just like in 1881, can get together and try to solve a problem. And I think this climate is favorable for reciprocal formation and will be for a while.
Thank you, David. Brian, Bruce, your thoughts?
I would just add to that the reciprocal model is really intended to be a low cost model to the consumer, to the policyholder. And we're a company that we've got growth plans, as do most insurance companies. And for us, we're not a nationwide, we're not an all state, we're not in all 50 states. We're more of a regional insurer. And as we want to grow, we look at the ability to bring that low-cost model through the reciprocal into new areas, new territories where many of the other big players are already there. But for us, I think it has the possibility to represent an economic advantage from a cost standpoint. And I don't, and again, and some of it will depend on what happens with respect to any future regulation around the management fee or things like that. But right now, our vision going forward is that it's a low-cost model, and it's something that we would like to move forward with in other areas, and that we think people would be happy to have.
Thank you, Brian. Bruce?
Yeah, I'll just add, I think availability of coverage is what drives formation of reciprocals. Any place there's a hard market and it's difficult to obtain coverage through the traditional offerings, or that coverage is very costly, I think is a environment that would stimulate interest in a reciprocal exchange. It's really just individual property exposures that people are trying to get coverage for at a reasonable rate, similar to what you see with risk retention groups for commercial liability coverages. So similar, we're exchanging exposures. Just to reiterate, because I saw a couple questions on this, the E-Committee is talking about some of the regulatory issues around reciprocal exchanges. They actually have a call next Wednesday, 1 p.m. Central Time, to talk about the charges for E-Committee groups for 2026. This is one of the charges that will be discussed, is some of the considerations around reciprocal exchanges. And once that charges discussion is completed, there's expected to be further discussion on those charges and the potential development of an NAIC model or adjustment of NAIC models in this area by the NAIC Executive Committee at the fall national meeting in Florida.
Thank you, Bruce. It has been a fascinating conversation over these past 60 minutes. Our time has elapsed. On behalf of both the NAIC Center for Insurance Policy and Research and the Institute's Griffith Foundation, I thank you, panelists. Dr. David Russell, Professor of Insurance and Finance at California State University, Northridge. Mr. Brian Bolash, Executive Vice President, Secretary, General Counsel at Erie Indemnity Company, and Bruce Jenson, Director of Solvency, Monitoring, and Accreditation at the NAIC. Really appreciate you sharing your insights and expertise with our audience. Take just a moment to invite our attendees to provide feedback by completing the very brief anonymous program survey that Eryn Campbell spoke of at the beginning of our program. Simply click on the link that appears in the chat box. You can access the survey. Your input is important to our organizations. And a final reminder that our program today will be available for on-demand playback in the days ahead. It will be posted to the respective homepages of the NAIC, CIPR, and the Griffith Foundation. With that, on behalf of Eryn Campbell and the team at the CIPR and all of us here at the Griffith Foundation, I thank you for joining us. Have a good day.